Okay, let's unpack this. Welcome to the deep dive. This is where we take source material, really dig in, and pull out the key takeaways, the essentials you need to know fast. Today, we've got a source looking at some really big shifts where finance and tech meet. We're talking blockchain, its growing impact, stablecoins, of course, and even a bit on AI shaking things up for banks. So our mission here, to cut through the noise, pull out what this source says is most important about how tech like blockchain is reshaping traditional finance and maybe even more. We want you to leave this deep dive really grasping the key trends and, well, what they could mean. And there are some surprises, like big banks suddenly getting very interested in crypto tech. You might be surprised where the impacts show up. All right, let's get into it. According to this source, what's really got the financial world buzzing right now?
Well, what's really striking, and with the source flags immediately, is this major pivot from the big U.S. banks. Giants like J.P. Morgan Chase, Bank of America, Wells Fargo, Citigroup. For years, they were, let's say, pretty cautious about crypto. But now, the source says they're reportedly exploring a jointly operated, fully fiat-backed stablecoin. Together.
Wow, okay. A joint stablecoin. That's a huge change from just a few years ago. What does the source suggest is driving that? What are they hoping to achieve?
Yeah, it's a definite shift. Their goal, according to the source, seems to be building a digital infrastructure that's crucially regulated and secure. And they want to weave this stablecoin into their existing payment systems. So leverage what they already have, but make it better.
So using their current rails, but adding this new tech layer.
Exactly. And they see it being used for, well, a whole range of things, from everyday peer-to-peer payments, like you and me sending money, right up to complex business-to-business settlements.
So playing to their strengths, using that established trust and infrastructure.
Absolutely. The source really highlights that. They see compliance and, institutional trust as their big selling points, their edge. It's kind of positioned as a contrast to the early crypto days. They're saying, we're the regulated, trustworthy option. The source even frames it like a battle for the digital dollar.
Battle for the digital dollar. I like that. It really paints a picture. Does the source give any specific examples of how this bank stablecoin might be used?
It does. Think about making instant payments, like through Zelle, actually settle immediately. No waiting. Or imagine large companies doing their Treasury reconciliations in real time. That could eliminate a lot of lag and potential errors.
Okay, I can see the appeal there. Speeding things up within the current system.
Right. But the source is also careful to note it's not like they have a clear field. They're jumping into a space where fintech firms have already built a lot. So competition is definitely expected.
Makes sense. Okay, before we go too deep, maybe we should back up slightly. For anyone listening, what exactly is a stablecoin according to the source material?
Good call. So simply put, the source defines stablecoins as cryptocurrencies, but one's designed to keep a stable value. And they usually do that by pegging their value to something in the real world, most often a major fiat currency like the US dollar.
Got it. And their role in the ecosystem, it feels like they're pretty important now.
Oh, definitely. The source portrays them as this crucial bridge. They connect the, let's say, sometimes volatile world of crypto with the stability of traditional finance. Because they don't have those wild price swings like Bitcoin, they're actually practical for things like payments, sending money internationally.
Without worrying the value will tank mid-transaction.
Precisely. They offer speed, lower costs, security for cross-border stuff, but without the crazy volatility risk. That's the key benefit highlighted.
The source mentions some big names, USDT, USDC, DAI. How do they typically maintain that peg? How are they backed?
Yeah, the source explains they're usually backed by reserves. Often a big chunk of those reserves are held in very safe traditional assets, things like government bonds, particularly U.S. Treasuries.
Huh. So there's a direct link between this new digital money and traditional government debt. That's interesting.
It really is. It creates this kind of strategic relationship that wasn't obvious at first.
And besides payments, does the source talk about why else they're popular? Maybe for bigger investors?
Yes, absolutely. Their stability is a huge draw for institutional players who want to get involved in decentralized finance, or DeFi. Things like lending protocols or earning interest on the blockchain. Stablecoins let them do that, get those potential yields, without the price risk of holding, say, Bitcoin or Ether directly.
Okay. Now, the source doesn't paint it as all smooth sailing, right? It mentions risks and controversies, too. It brings up USD1.
That's right. The source uses the example of USD1, which it notes was linked to the Trump family's company. And it says this raised concerns around transparency and potential conflicts of interest. It's used as an example to show that, questions about backing and operations are definitely part of the stablecoin story.
So trust and transparency are still key issues.
Very much so. And regulation is still playing catch-up. The source suggests the U.S. might be moving a bit faster than Europe on creating clearer rules, but it's still evolving. But if you zoom out, the bigger picture the source paints is, well, stablecoins are becoming really foundational, not just for crypto trading, but for the whole digital economy, how value moves online.
Right. And thinking about that future, the source mentions insights from a City Institute report with some projections.
It does. And that report is pretty bullish. It points to maybe 2025 as a key year for broader blockchain adoption kicking in, especially in finance and the public sector. They see clearer regulations as being a big driver for that.
And the growth forecasts for stablecoins themselves by 2030.
Yeah, the numbers are quite something. The report estimates that the total stablecoin supply could hit $1.6 trillion, potentially even $3.7 trillion in a really optimistic scenario. Though, even if challenges slow things down, they still see it nearing maybe $500 billion. So, significant growth seems likely either way.
And is that growth expected mainly in U.S. dollar stablecoins?
It's like it. The report predicts that, yeah, the vast majority, maybe 90%, will likely remain U.S. dollar denominated. That's even while other countries are working on their own central bank digital currencies, or CBDCs.
Okay, let's go back to that Treasury connection you mentioned. What does the City report, via our source, say about the impact there?
This is fascinating. Because issuers hold treasuries to back their stablecoins, the report suggests that as the stablecoin market explodes, these issuers could become major new buyers of U.S. government debt, potentially among the largest holders by 2030.
Wow, so this digital currency boom could actually create significant new demand for traditional government bonds.
Exactly. It's this unexpected feedback loop between the digital and traditional financial worlds.
And for the banks we started with, the ones potentially launching their own stablecoin, the source sees this whole trend as kind of a mixed bag.
It does. A bit of a double-edged sword, as the source puts it. On one side, stablecoins could threaten them, maybe pulling customer deposits away. But on the other hand, it opens doors for new services. Custody for stablecoins, facilitating institutional trading, building new products around them, opportunity and threat.
Okay, so that really covers the stablecoin angle well. But the source makes it clear blockchain's potential isn't just about stablecoins, right? It talks about other areas, like the public sector.
That's right. There's definitely growing interest there. Governments are looking at blockchain, mainly because they're focused on improving transparency and accountability, especially around public spending.
What kind of uses does the source mention?
Things like tracking how public money is spent, distributing subsidies or aid more efficiently, managing public records securely, even using it for humanitarian campaigns to make sure aid gets where it's needed. Also things like tokenizing assets or improving digital identity systems.
Sounds promising, but maybe early days.
Yeah, the source adds that caution. Initial uses might be small scale, and there are risks in implementing it. But the fact that governments are seriously exploring it, that's seen as a pretty big signal for wider adoption down the line.
And the source has this really specific, compelling example from South Africa about financial reporting using blockchain. This sounds like a very practical application.
It really does.
Yeah.
The source lays out this problem in South Africa, where small businesses face incredibly high costs for financial audits. It's a real barrier for them.
A structural barrier, yeah. So how does blockchain help?
Well, by creating the shared immutable ledger of transactions, it makes the financial data transparent and verifiable in real time. This drastically cuts down the need for those costly, manual, after-the-fact audits. The source even cites research suggesting it could reduce the audit effort by up to 30%.
30%. That's huge, especially for a small company trying to grow. What other benefits does the source list?
Well, lower audit fees, obviously, but also more accurate records, which is always good. It frees up the business owner's time. They can focus on running the business, not just compliance paperwork. And crucially, it helps them automatically build that verifiable financial history they need.
Ah, and that history is the key to getting funding, right?
Exactly. The source makes that link very clearly. Having those easily verifiable records makes it much easier for small businesses to access things like bank loans or bid on government contracts or attract investors, all things that require solid financial proof.
And this isn't just for small businesses.
No, the source broadens it out. Big companies could use similar tech internally to streamline controls, maybe reduce fraud risk, shorten their own audit cycles. And for the public sector itself, Imagine tracking government budgets with that kind of real-time transparency, monitoring spending, auditing departments. It could really boost accountability and potentially reduce corruption risks.
It really makes you think about how much effort goes into just verifying things currently.
It does. And it raises that deeper question the source touches on. How does technology like this actually change the nature of trust and transparency, not just in business, but maybe even between citizens and the state?
A big question indeed. Okay, and finally, the source shifts gears slightly to bring in another huge tech force hitting banks. AI, artificial intelligence.
Yes, and the picture here, according to the source, is maybe a bit concerning for the banks. It references a survey finding that only about a quarter, just 25%, of banks have really integrated AI into their core strategy. Most seem stuck in pilot projects.
Only a quarter. And what's the risk if they don't move faster?
The source argues it's a massive risk. They could get seriously left behind by the more nimble digital native competitors. Companies that are using AI are doing things like hyper-personalizing advice, automating complex processes like loan approvals down to minutes, totally changing the customer experience.
So AI is essentially eroding those old advantages banks had.
That's the argument. The source talks about AI dismantling those traditional moats like customer inertia, people just sticking with their bank, or the lack of price transparency. AI-driven services are often slicker, faster, more transparent, forcing banks to fundamentally rethink how they provide value.
The source sounds like it's really stressing the urgency here.
It absolutely is. The message seems to be
Right.
the banking landscape is changing fast, and banks that don't adopt AI strategically and soon risk becoming irrelevant or losing huge chunks of market share.
So what does the source say banks need to do? What are the steps?
It lays out 4 key things. First, they need to genuinely upgrade their strategy, figure out where AI gives them a real edge, not just tinkering. Second, AI has to be central to their tech and data plans, not just bolted on. Third, they need to get ahead of the curve with regulators, figuring out AI governance. And fourth, they need to reorganize talent and structure to actually use AI effectively. It's a big shift.
Wow. Okay, so if we try and connect all these different threads from the source, we're seeing traditional finance really grappling with multiple powerful tech shifts simultaneously.
Exactly. It's not just one thing. You've got them directly engaging with blockchain through stablecoins, potentially reshaping digital money. Then there's the broader potential of blockchain for transparency in government and business reporting. And overlaid on all that is this urgent imperative to adopt AI, which changes how they operate internally and compete externally.
These forces aren't separate. They're interacting and pushing finance in a new direction.
That's the core takeaway, I think.
Yeah.
The source shows these technologies collectively reshaping the structure, the transparency, even the accessibility of financial systems. It's pushing towards something more digital, more efficient, more data-driven.
Right. So just to quickly recap for everyone listening to this deep dive, we saw the big banks making a surprising move towards their own stablecoins. We explored what stablecoins are, their growing importance, that interesting link to U.S. Treasuries.
And then we look beyond stablecoins, how blockchain might bring more accountability to government, how it could transform business reporting using that South Africa example.
Exactly. And finally, that stark warning about AI, the need for banks to really embrace it or risk falling behind fast.
And the underlying message from the source seems to be that tech isn't just a tool for finance anymore. It's becoming a fundamental force, changing the very fabric of how money works, how trust is built, how systems operate.
And for you, our listener, getting your head around these interconnected shifts hopefully gives you a clearer view of where finance is likely headed, the forces shaping the systems you use every day.
Which leads us to that final thought, something to chew on. If stablecoins do become major buyers of government debt, potentially influencing public finance, and if blockchain reporting does significantly boost transparency in how governments spend our money, how might this convergence of digital finance and government finance start to change the actual relationship, the trust dynamic between citizens and the state in the coming years?
Definitely something to think about. And that concludes our deep dive for today.